Why private equity is making insurance unaffordable, the next housing crash. The letter said her claim was not medically necessary. 48 hours earlier, her husband's surgery had been scheduled. Now the hospital wanted $42,000 up front. While she argued on hold, her auto insurer emailed a 28% premium increase. That afternoon, their home policy non-renewed, wildfire risk zone, effective in 30 days. 3 bills, 3 denials, 1 family. They hadn't missed a payment in 20 years. To understand how one ordinary week became a financial chokehold, we need to go back, not to Congress or Wall Street headlines, but to a quiet deal sheet. The kind nobody notices until the safety net disappears. The buyout nobody notices. It starts with a press release that sounds harmless. A leading insurance platform announces a strategic partnership with an investment firm to accelerate growth. No sirens, no protest signs, just a logo swap and a new tagline about innovation. The first hint comes at renewal. Your broker calls and says, "Market's hardening. We'll shop it around." Your premium jumps, but the forms are familiar, so you sign. Meanwhile, something else is happening. Back at headquarters, the new owners are rolling up agencies, standardizing software, and centralizing underwriting. The cost savings look great in a deck. The changes are invisible on your kitchen table. Here's the play. Private equity buys an insurer or a brokerage platform at a high multiple. They add debt, then race to bolt on smaller agencies at cheaper valuations. Each acquisition is accretive. Overnight, the number of independent buyers shrinks, and the big platforms set the tone. The top 10% of acquirers now control more than half of agency deals. Fewer bidders means less pressure to keep your rates down. That pressure moves somewhere else onto you. What nobody tells you. Insurance is 2 businesses stitched together. The front end you see, policies, claims, renewals. And the balance sheet you don't, where your premiums become investable capital. For asset managers, insurers aren't just risk pools, they're permanent capital. Own the float, earn fees on it, and every policy is suddenly a financial product. In that world, the real customer can look less like you and more like the spreadsheet. Meanwhile, the safety valves that used to soften shocks are tightening. Reinsurance, the insurance for insurers, has gotten more expensive and more selective, attaching higher on catastrophe layers, pushing stricter terms, keeping returns well above the cost of capital. Primary carriers either buy less protection or pay more for it. Either way, that cost tries to pass through the pipe. When it hits your street, it looks like a 20% auto jump, a home non-renewal, and a health denial that requires additional documentation. Now shift to the claims desk. Automation flags an out-of-network anesthesiologist. The system denies first, requests more records, and resets the clock. Providers appeal, but appeals take time, and time is leverage. Most customers never appeal at all. On paper, denial rates are just a metric. In practice, they're a gate between you and the care your doctor already ordered. Multiply that by millions of claims, and you've found a profit lever that doesn't need a headline. Add one more gear. Offshore capital relief. Move liabilities to friendlier jurisdictions, hold less in reserve, and invest the difference in higher-yield private assets. It's legal, efficient, and when markets cooperate, lucrative. But the point isn't moral judgment, it's incentives. If the return engine lives in the investment portfolio, underwriting discipline tightens, pricing hardens, coverage narrows, and claims scrutiny intensifies. That's not a conspiracy. It's a spreadsheet doing exactly what it's built to do. For the middle-class family on the other end, it lands as a rhythm. Auto, we're adjusting for lost trends. Home, we regret to inform you. Health, prior authorization required. Each letter is technically accurate. Together, they change how you live. You drive less. You increase deductibles to keep premiums manageable. You postpone a procedure because the peer-to-peer review is next Tuesday and your kid's got a game. None of these are dramatic alone. All of them add up. Here's where it gets more personal. Your broker used to be a person with a storefront. Now, that agency was bought by a platform that was bought by a fund. They still pick up the phone, but their markets are consolidated, their commissions restructured, and their marching orders tighter. They can move your account, but there are fewer places to move it. The independent choices you assumed you had were quietly merged into one of a handful of national players. What changed the most wasn't the card in your wallet, it was bargaining power. When insurers can raise premiums across a market that's consolidating, and reinsurance costs support those increases, and capital owners expect double-digit returns. The squeeze has somewhere to go. It goes to the households that made the safety net possible by paying faithfully for decades. This was the buyout nobody noticed. No layoffs on the evening news, no sirens in the street. Just a series of optimizations that, stacked together, turned protection into product. By the time anyone feels it, the deal's already closed, the add-ons are complete, and the new normal has a new price. The denial machine, AI meets actuary. The letter says, not medically necessary. But the decision didn't come from a doctor in a white coat. It started with a model, an algorithm trained on millions of past claims, coded to spot patterns and outliers, sits between you and approval. It doesn't hate you. It scores you. If the score crosses a threshold, a human might review. If it doesn't, the denial goes out. Clock starts. Appeals window opens. Most people never walk through it. What nobody knew at the time, denial rates had been creeping up across the board. Marketplace plans were rejecting nearly 1 in 5 in-network claims. Medicare Advantage hovered in the mid-teens. Providers reported spending hours every week on prior auth ping-pong. On paper, those are efficiency metrics. On the phone, they're delay tactics. The business case is simple. Even if half the denials are later overturned, only a sliver are appealed. Friction saves money. Here's where AI meets actuarial math. Traditional underwriting price pools, age, geography, driving history, credit-based insurance scores. Now, models ingest hospital billing codes, provider patterns, social determinants, and even obscure proxies that correlate with risk. In auto, telematics feeds a constant stream of data. Hard braking, nighttime driving, zip code exposure. In home, satellite imagery and wildfire maps update risk scores monthly. Health plans plug in predictive analytics to forecast medical necessity before a claim is filed. It sounds like precision. It behaves like triage. Meanwhile, something else was happening inside the workflows. Insurers automated initial denial for incomplete documentation or suspected coding errors, knowing providers would correct and resubmit. That creates a second touch, a second delay, and crucially, a second chance to push costs back onto the system. Multiply by millions, and the float, those dollars sitting invested before they're paid, grows fatter. For asset owners, every extra day is basis points. In the call center, the scripts change. Representatives aren't authorized to approve, they're authorized to explain. We need a peer-to-peer review. We need a step therapy trial. We need proof of loss in a different format. Each requirement is defensible. Together, they form a maze. Providers know the turns, but even they burn out. A hospital revenue cycle director keeps a whiteboard tally of denials overturned on appeal. Wins feel good. The ratio doesn't budge. Now look at property and auto. After a storm, adjusters used to walk roofs. Today, drones map damage, AI estimates, and software recommends a settlement. It's faster, but the first offers trend lower. Contractors push back, supplement the claim, argue line items. The back and forth can drag for months. Homeowners take the check because school starts next week and the tarps are flapping. Acceptance of payment is not a release, the check stub says. Most people don't test that sentence in court. What nobody sees is the governance layer. A weekly dashboard rolls up denial rates, appeal overturn ratios, cycle times, loss ratios, and premium lift. Executives don't say deny more. They set targets, reduce average paid per claim by 2%, cut claim cycle time by 3 days, increase prior auth compliance. Product owners tune thresholds. Vendors pitch AI-assisted adjudication that promises accuracy and speed. The ROI case is clean. The human cost is off-model. There was one problem. The models learn from history. If historical claims reflect undertreatment, bias, or gaps in access, the machine bakes it in. Regions with fewer specialists look low utilization, which reads as lower expected cost, until a crisis hits. Communities that underutilize care to avoid surprise bills get scored as less risky, until they don't. The actuarial math isn't wrong. The inputs are incomplete. Precision without context can be dangerous. Back on Main Street, the family feels the edges. Their health plan flags the surgery for step therapy. Their auto claim routes to a virtual inspection. Their home insurer uses a wildfire model that moved their neighborhood from watch to redline after a dry winter. The broker explains reinsurance tightened. The letter says non-renewal. The appeals timeline says 30 days. The budget says not possible. Meanwhile, in boardrooms, private equity owners talk about operational excellence. Centralize claims. Outsource low-complexity adjudication to a vendor with AI triage. Consolidate TPAs. Renegotiate. With provider networks using denial data as leverage. Shift runoff blocks offshore to lower capital charges. None of this is illegal. Much of it is industry standard now. But stack it, and the path of least resistance flows in one direction. Providers push back. Attorneys file suits over blanket denials, arbitration clauses, and medically necessary definitions. Some appeals win. Regulators ask for denial transparency reports. A few states publish dashboards. The graphs confirm what patients already felt. Denials up, appeals rare, reversals common when someone fights. The system isn't failing, it's working as designed for someone else. This was the moment everything changed, not because a law passed, but because code did. When AI sat down next to actuaries, the gate moved from the front desk to the back end. The safety net didn't tear. It tightened. And for a middle-class family keeping up, that difference is the whole story. Pricing without protection. 3 months after the surgery fight, their escrow letter arrived. Mortgage up $214 a month, insurance shortage. The premium hadn't just increased, coverage had changed. The roof settlement was now actual cash value, unless they added a new endorsement. The wildfire deductible had shifted to a percentage of dwelling value. Same house, smaller promise, bigger bill. To understand why, we need to go back to the pressure points. Reinsurance pricing reset after back-to-back catastrophe years. Attachment points moved higher, terms tightened, and reinsurers targeted double-digit returns on equity. Primary carriers had a choice: shrink exposure, buy less protection, or push price and restrict coverage. They did some of each. In catastrophe-exposed states, non-renewals spread. Elsewhere, policies stayed, but with add-ons, sublimits, and exclusions that did the same job quietly. The family's broker walked them through the new menu. Want wind coverage? There's a separate deductible. Want replacement cost on contents? That's an endorsement. Sewer backup? Another rider. Each option sounded rational. Together, they reconstructed the old policy in pieces, each with a fee. It felt like buying the same car twice, once for the frame and again for the doors. Meanwhile, personal auto followed its own logic. Loss costs rose, parts inflation, more severe crashes, pricier repairs for sensor-loaded bumpers. Carriers filed for increases. But something else had shifted: segmentation. Telematics discounts for some, surcharges for others. If you didn't opt into data sharing, your rate sat in the middle, creeping upward. If you did, the app pinged you for hard braking on a pothole. Either way, premiums climbed. Coverage limits didn't. Health moved in parallel. Employer plans exchanged broad networks for narrow ones. Prior authorization lists grew. Co-insurance rates ticked up. The premium on paper looked manageable because deductibles did the heavy lifting. Catastrophic coverage disguised as comprehensive. At the capital level, the math rewarded this pattern. Insurers grew premiums faster than GDP. Investment portfolios swelled. Private equity owners emphasized expense ratios and underwriting discipline, which translated meant shaving claim severity and tightening terms. If reinsurance capital was finally earning 13 to 18% returns, primary carriers could justify rate hikes that stuck. Competition that used to hold pricing in check was thinner after roll-ups. The result wasn't just higher rates. It was higher rates for less. The family tried to shop the home policy. The independent broker checked markets. 2 declined due to wildfire maps. One quoted a price 40% higher with a 5% deductible on catastrophes. The last offered coverage if they trimmed trees, replaced vents, and installed ember-resistant screens. Reasonable mitigation, expensive upfront. They pulled savings to meet the requirements. The approval came with a note. Carrier reserves the right to adjust terms at renewal based on updated risk scores. A moving target. There was one more turn of the screw. Mortgage lenders require continuous coverage. When carriers non-renewed, banks stepped in with force-placed insurance. Bare bones, costly, protecting the lender's interest, not the homeowners. The family avoided that, but their neighbors didn't. The block group chat turned into an insurance clinic. Tips traded like coupon codes. No one had a fix. On the health side, their HR rep announced a new cost stewardship program. Virtual visits first. Tiered hospitals. A pharmacy benefit that steered them to preferred alternatives. The savings claim sounded good. Then their son's inhaler switched to a different formulation. It worked, kind of. The old one needed a medical exception. The doctor filed it. Weeks passed. The refill date came and went. Here's where it converged. In theory, insurance spreads risk. In practice, the floor lowered while the price rose. The insurer's solvency looked strong. The reinsurer's returns looked healthy. The asset manager's fees flowed. The family's safety net thinned. What nobody at the kitchen table saw was the spreadsheet logic. Raise premiums 8 to 10% across a book, narrow coverage via endorsements, manage claim costs with automation, and preserve capital by shifting peak risk to policyholders through percentage deductibles and exclusions. It wasn't a secret. It was the market. The letter that landed last was the sharpest. We regret to inform you that your property no longer meets underwriting criteria due to updated wildfire risk modeling. The broker fought for an exception. No luck. The assigned state-backed plan quoted triple the premium with limited coverage. The family stared at the number. Sell the house or pay the toll. They chose to stay. They cut back. They set aside an emergency fund for deductibles that used to be covered losses. Protection had become a gamble they carried themselves. Pricing without protection isn't a slogan. It's a budget line, due every month. The reinsurance squeeze. While all that was happening at the kitchen table, another story was unfolding far upstream. It didn't make the evening news because it rarely does. It showed up in seeded premium schedules, attachment points, and wordings that only a handful of people in each company ever read. But that's where the squeeze began. To understand why their home policy evaporated, we need to go back to a January renewal in a glass-walled conference room. A primary insurer brought a catastrophe program to market. The map on the screen glowed with wildfire corridors, hurricane tracks, and convective storm swaths that had crept into zip codes once considered safe. Loss models ran hotter. Reinsurers didn't argue the models. They priced them. For a decade, reinsurers had absorbed billions in weather surprises and secondary perils that proved not so secondary. In 2023 and 2024, they rewrote the deal. Capital was disciplined. Headline returns finally outpaced the cost of capital. Terms tightened. Higher attachments, narrower reinstatements, exclusions that carved out the worst layers, and a clear message. We'll take risk, but not at yesterday's price. The primary insurer stared at two options. Pay up for roughly the same protection, or buy less and hold more risk. Either way, the cost had to go somewhere. Rate filings told one story. Adverse loss trends, catastrophe experience, reinsurance market conditions. The family saw the translation. A non-renewal letter in a wildfire zone and a 28% auto increase justified by severity and parts inflation. The company's solvency looked prudent. The household's budget absorbed the prudence. Meanwhile, something else was happening. Dedicated reinsurance capital swelled again, but it stayed selective. Alternative capital, insurance-linked securities, cat bonds, returned with higher coupons and stricter triggers. Property layers at the very top softened slightly for the safest attachments, but the middle where communities live stayed firm. Reinsurers posted underlying combined ratios in the mid-90s and double-digit ROEs. The lesson stuck: discipline pays. Primary carriers got the memo. At renewal season, negotiations turned granular. Your book's mix has shifted. Your wildfire mitigation credits aren't enough. We'll renew capacity, but the attachment moves up $50 million and hours clauses tighten. A small tweak on a slide deck turned into a major shift in retained risk. The actuaries recalibrated. Product managers pushed percentage deductibles and peril-specific sublimits. The family never touched those levers, but they paid for them. Unknown to them, across town, their state's residual market swelled. Fair plans and state-backed insurers of last resort took on properties private carriers declined. Premiums in those pools climbed, coverage narrowed, and taxpayers became the backstop behind the backstop. When a carrier left, the risk didn't vanish. It moved to a balance sheet with a public address. Reinsurance is supposed to be the shock absorber. In 2025, it worked like one for reinsurers. Combined ratios looked clean because pricing was disciplined and structures shed volatility back to primaries. Primaries then shed volatility to policyholders through higher deductibles, exclusions, and non-renewals. The shock didn't disappear. It traveled. In the boardroom, the private equity owners didn't dictate catastrophe pricing. They didn't have to. They set return hurdles. When reinsurance could earn 13 to 18% ROE, no one wanted to subsidize underpriced primary risk. The new owners told management to be selective, protect the balance sheet, and grow premiums where rate adequacy held. That's rational. It's also how neighborhoods become uninsurable on paper long before a match is ever struck. 3 days after the non-renewal, the broker called with an option, a surplus lines policy. Higher price, stricter terms, no guarantee of renewal, and a wildfire deductible tied to dwelling value. The reinsurer. Behind it was global, well-capitalized, and careful. Capacity was rationed. Take it quickly, the broker said. The panel could fill. The family signed. The panel filled. Here's where it gets technical, but it matters. When reinsurers raise attachments, primary carriers keep more of the first dollars of loss. That pushes them to manage claim severity aggressively and restrict coverage on the very perils most likely to pierce their retention. When frequency seasons turn active, hail clusters in the plains, wind events in the southeast, those retained losses erode margins fast. To rebuild margin, carriers file for rate. Regulators see reinsurance costs and catastrophe experience and allow increases. The loop closes. What nobody knew at the time, the reinsurance market's strength was a leading indicator. When capital is confident and selective, it forces discipline downstream. That discipline looks like fewer competitors at your kitchen table and more letters that begin with "we regret." In the aftermath, the family's budget absorbed the new premium. Their emergency fund became a de facto reinsurance layer, their own retained loss. They installed the Ember Guards, cleared defensible space, and hoped the next model update wouldn't tip them back into no. Upstream, the reinsurer's quarterly slide deck showed stable returns and a line about supporting resilience. Both statements were true. Only one paid the invoice. The mortgage insurance trapdoor. 3 weeks after they signed the surplus lines policy, the bank letter arrived. Escrow shortage detected. The new premium blew a hole in the mortgage math. Their payment would jump in 30 days unless they wired the difference. Miss it, and the lender would procure lender-placed insurance to protect its interest. That phrase sounded dull. It wasn't. Here's how the trapdoor works. Mortgages are built on a promise. Keep taxes paid and insurance active. The bank's collateral, the house, must be insured to the lender's standards. When an insurer non-renews or a premium triples, the borrower scrambles. If coverage lapses, the servicer steps in with force-placed insurance. It's fast, expensive, and thin. It covers the structure for the bank, not the family's belongings, not loss of use, not many of the things a homeowner expects. The premium gets added to the mortgage bill, retroactive to the lapse date, with fees. It's compliance by penalty. What nobody tells you up front is how quickly the sequence moves. Carriers send non-renewals 30 to 60 days ahead. Borrowers shop. Quotes drag. Underwriting asks for roof photos, mitigation work, sometimes full replacements. The clock runs. If a binding date slips past the renewal, the bank system flags a lapse and automatically triggers lender-placed coverage. Even if you secure a policy 2 days later, the force-placed premium for those 2 days may stick for the month. Try arguing with a call center that's outsourced and reading from a script. You'll get there. You'll burn time and money doing it. Meanwhile, the private equity logic is humming in the background. Servicing platforms, some owned or backed by investment firms, optimize for recoveries and compliance. They aren't villains, they're targets. Keep collateral insured, minimize loss severity on defaulted loans, and pass costs to borrowers per contract. The spreadsheet doesn't see a family budget. It sees a risk flag, a cure path, a fee schedule. Their servicer offered 2 choices. Pay the escrow shortage upfront or spread it over 12 months with a higher payment. They chose the spread. It meant less slack everywhere else. The lender also demanded proof their new surplus lines policy met minimum dwelling limits and mortgagee clause language. The broker adjusted the certificate. Another week gone. There was a second trapdoor under the first. If premiums keep rising, escrow keeps recalculating. Each annual analysis can ratchet the payment again. In a tight budget, small increases compound. Miss enough payments and a cured insurance lapse becomes a mortgage delinquency. Delinquency fees hit. In a market where home prices have cooled and refinancing isn't an option, the math corners you. You don't need a crash to lose a house. You just need a treadmill you can't slow down. Unknown to them, across town, their neighbor hit the bottom first. The carrier pulled out. She missed the replacement window. The servicer force-placed coverage at double her old premium. Her escrow shot up. She fell behind 2 months, then 3. A default letter arrived. She found a new policy in month 4, but the arrears remained. A workout plan added months to her loan and capitalized fees. She kept the house. She lost her cushion. Now layer in health and auto. Their son's inhaler exception finally approved, but at a higher tier copay. The auto premium renewed 14% higher despite no accidents. The family cut streaming, delayed dental cleanings, sold a second car. None of it touched the escrow increase. That payment was a wall. The system had one more lever: insurance to value. Appraisal rules and replacement cost estimators pushed dwelling limits higher to reflect inflation. On paper, that's appropriate. In practice, when you insure to a higher limit with percentage deductibles on catastrophes, your out-of-pocket rises automatically. A 5% wildfire deductible on a $600,000 dwelling limit is $30,000 before the insurer pays $1. The lender is protected. The reinsurer's treaty is structured. The homeowner becomes the first layer. Their broker suggested a mitigation loan. New Class A roof, ember vents, cleared defensible space. Some carriers offered credits. A few offered eligibility. The bid came back at $28,000. The state offered a grant waitlist. They joined it. They couldn't wait. They financed part of the roof at a rate above their mortgage, tacking a second payment onto the month to keep the first payment from exploding further. A strange compromise, more debt to hold back worse debt. Meanwhile, servicers sold blocks of mortgages to other servicers. A transfer notice arrived. New payment address. New escrow rules. New insurance documentation portal. Their broker uploaded certificates again. The portal rejected the file due to a naming convention. Another call. Another hour. The trapdoor wasn't a single drop. It was a staircase. In the boardrooms where these systems are designed, nobody talks about families. They talk about exceptions processing and vendor SLAs. They discuss cure rates after insurance lapses and cycle times to obtain proof of coverage. They analyze foreclosure pipeline health under different catastrophe scenarios. If a hurricane hits, how many loans will flip to force-placed? What's the recoverability curve? These aren't bad questions. They're incomplete ones. Here's the through line. Private equity didn't invent escrow shortages or force-placed insurance. But a consolidated insurance market, disciplined reinsurance, and investment-led ownership stacked the incentives. The lender must protect the collateral. The insurer must protect the balance sheet. The reinsurer must protect returns. The gap between those protections is where the household stands. The family made it through the year. They caught up on escrow. They kept health coverage. They drove less. They stopped talking about vacations. They started talking about leaving the state. Not because they wanted to, because the math kept asking the same question. How much longer can you hold the floor by yourselves? From premiums to policy, regulatory capture. While the family was juggling escrow and denials, the rulebook that governs all of this was being edited in slow motion. Not rewritten in one dramatic vote. Edited, phrase by phrase, in meetings few people watch and comment periods few people read. The outcome wasn't a headline. It was a tilt. To understand how premiums turn into policy, start with who shows up. Insurance commissioners depend on data to approve rates and judge solvency. Carriers bring teams of actuaries. Reinsurers bring loss models. Brokers bring market color. Consumers bring stories. In a technical hearing, stories are considered anecdotes. Models win. Approvals follow the math on the page. Meanwhile, something else was happening in the background. The industry consolidated. The same large platforms that bought local agencies also built lobbying weight. Trade groups sent white papers explaining why claims severity rose, why catastrophe models shifted, why rate adequacy required double-digit hikes. Regulators asked for evidence. The evidence came from the firms seeking approval. It wasn't fraudulent, it was asymmetric. In health insurance, denial transparency became a talking point. States requested denial and appeal data. The table showed what patients felt: high initial denials, low appeal rates, significant reversals when challenged. The fix seemed obvious: require clear reporting, penalize abusive patterns. But rulemaking takes time, and during that time, automation scaled. By the time dashboards went public, the workflow was already baked into software contracts and vendor SLAs. At the national level, the line between insurance and asset management blurred. Private equity firms acquired insurers not just for underwriting profit, but for permanent capital, float that could be invested in private credit and alternative assets. Regulators raised questions about complex ownership, offshore reinsurance to Bermuda, and asset concentration. Industry responses emphasized diversification, improved returns, and strong risk controls. Reviews opened, comments were filed, and deals closed while discussions continued. Here's the quiet mechanism. Rate filings are technical, and solvency oversight is conservative by design. When reinsurance prices rise and catastrophe losses mount, regulators face a trade, allow higher rates or risk insurer distress. In that frame, household affordability sits outside the mandate. Approvals arrive with language about actuarial soundness and market stability. The result can be rational and still brutal at the kitchen table. Unknown to the family, across the Capitol, a hearing addressed non-renewals in wildfire zones. Consumer advocates described a coverage crisis. Carriers described models, reinsurance costs, and concentration risk. A proposed fix offered mitigation credits and expedited approvals for carriers that stayed. It helped at the margins. It didn't change the red lines on the maps or the return hurdles on the deals. Health policy offered a similar pattern. Prior authorization reforms standardized timelines and required clinical rationales. Plans complied by building more precise denial pathways, hiring more utilization reviewers, and embedding criteria into decision engines. Regulators touted faster responses. Patients still waited for approvals that arrived 2 days after surgery dates had to be canceled. Then there's enforcement. When carriers violate notice rules or mishandle claims, penalties hit. They sound large. Spread across a national book, they're a rounding error compared to the savings from tighter adjudication. The incentive is clear. Fix the obvious, absorb the fine, keep the system that moves dollars predictably. One layer deeper sits model governance. Catastrophe and underwriting models are intellectual property. Regulators see outputs, sometimes methodology summaries, rarely. Full code. When a model upgrade hardens a zip code, the homeowner's recourse is limited. Appeal to whom? On what grounds? The decision lives inside a black box that passed a review that couldn't fully open it. Meanwhile, revolving doors spin slowly. Experienced regulators move to industry compliance roles. Experienced industry actuaries take seats on advisory panels. The expertise overlap is real and often valuable. It also shapes the questions being asked. If the default frame is solvency first, competition second, consumer impact third, then affordability becomes a footnote in a safe system that people can't afford to use. The family doesn't know any of this. They know they called their commissioner's office. A staffer listened, suggested filing a complaint, and logged the case. Months later, a form letter arrived stating the carrier complied with state law. The letter wasn't wrong. The law was. Across town, a state-backed insurer expanded. Legislators debated assessments to fund residual markets. The trade-off was stark. Either we subsidize risk openly through public pools, or we subsidize it privately through higher premiums and narrower coverage. They chose a bit of both, which meant everyone paid, just not evenly. Here's the blunt truth. Regulatory capture in insurance rarely looks like a bribe. It looks like complexity that favors the side with more experts, more data, more time, and more at stake per decision. It looks like solvency framed as the only safety worth protecting. The family kept paying. The market stayed stable. The net held, just higher up, where fewer people could reach it. Climate, crime, and the new risk map. By summer, the family noticed something odd on the neighborhood forum. A string of posts about catalytic converter thefts, porch pirates, and a break-in down the block. Police reports filed, camera footage shared, nothing dramatic on its own. A week later, their renewal quote arrived with a line they hadn't seen before. Theft frequency adjustment. The premium inched higher. Climate felt abstract. Crime felt close. The insurer's model treated both as signals. Here's the shift that matters. Insurers don't just price your address anymore. They price your block's dynamic risk. Climate models update wildfire, flood, and convective storm maps monthly using satellite data and weather reanalyses. Crime scoring overlays police reports, claims data, and even social media incident clusters. A heat dome means higher secondary peril risk. Hail and wind that crack skylights halfway across the state. A theft spree within a 1-mile radius nudges comprehensive auto rates. The map moves, even when your house doesn't. Meanwhile, something else was happening in their city. After 2 dry winters, their county entered extreme drought. Grass crisped, red flag warnings spiked, and a brush fire jumped to freeway median. Contained in a day, no homes lost, but the plume of smoke was visible from their street. Their carrier's wildfire model recalibrated. Mitigation credits helped, but the base score rose. The broker tried to argue the fire line stopped miles away. The model didn't debate. It updated. On the other end of the spectrum, water found new paths. A thunderstorm parked over neighborhoods that never worried about flood. Drains backed up. Basements filled. The family's friends across town learned the hard way that not in a FEMA flood zone didn't mean dry. Their homeowners' policy excluded surface water. They asked about adding flood after the fact. The agent explained private flood markets had capacity, but pricing reflected new rainfall patterns. The quote felt like a penalty for a storm cloud swim. Insurers call these secondary perils, but they're not secondary in the budget. Hailstorms used to be a regional headache. Now they march across states, pocking roofs and spiking claims. Severe convective storms cost more each year, not because a single event breaks the system, but because the drumbeat never stops. Reinsurers see it in their data and tighten terms. Primary carriers reorganize their portfolios. Households see it on invoices labeled catastrophe load. Then there's crime. The family's car was fine, but 2 blocks over, a neighbor's SUV got hit twice in a month. Comprehensive claims posted. Telematics didn't track thieves, it tracked the family's own driving. Still, the zip code signal grew louder. The renewal letter cited local loss trends. It didn't need to say crime. The actuarial note did. Now layer in fraud. After the hailstorm, roofing canvassers flooded the area promising free roofs. Some filed inflated estimates, pushed aggressive supplementing, and disappeared when checks cut short. Insurers built models to flag suspicious contractor patterns. Legitimate contractors hated being lumped in, but the models didn't navigate reputations, they navigated anomalies. The result, slower approvals for everyone in a hot zone. The family watched tarps linger long after the storm. Moved on, waiting for second and third reviews. Climate and crime used to live in separate columns. In the new map, they reinforce each other. A prolonged heat wave drives up cooling bills and pushes tempers. A blackout during a fire scare empties neighborhoods, making empty houses easier targets. After a disaster, theft claims spike, sometimes opportunistic, sometimes survival. Insurers see the co-movement and bake it into pricing. The model's job is to see connections humans miss. The question is whether the household can afford the connections once they're priced. Meanwhile, the state tried to get ahead of it. Grants for defensible space. Credits for Class A roofs. A pilot program offering subsidies for home hardening in high-risk tracts. The family applied. Waitlisted. Capacity was small, demand large. Their council member held a town hall. Residents asked why, after paying premiums for decades, mitigation now felt like an extra tax. The insurer's representative said the quiet part carefully. Mitigation helps, but the hazard baseline is rising. Credits soften increases, they don't erase them. Unknown to them, across the country, coastal towns faced a parallel squeeze. Tidal flooding on sunny days. Nuisance claims that weren't catastrophic, just relentless. Private carriers trimmed coastal exposure. State pools swelled. Premiums climbed. Real estate listings added elevated mechanicals like a selling point. In the Midwest, tornado alleys shifted. In the Northeast, rainfall intensity maps redrew basements into risk. Everywhere, people who'd never filed a claim learned an underwriting vocabulary they never wanted. The crime side had its own feedback loop. Police staffing shortages stretched response times. Prosecutors triaged caseloads. Retail theft made headlines, but homeowners felt it in small ways. A stolen bike here, a shattered window there. Insurers adjusted deductibles for theft, added sublimits for certain items, and recommended security upgrades. The family bought motion lights, registered their serial numbers, and tucked laptops out of sight. The premium didn't drop. The loss frequency map didn't care about their one porch. Here's the part that stings. The family did everything right: mitigations, documentation, community watch, and still watched rates rise because the map around them changed. Models priced the neighborhood, not the household. That's efficient for a portfolio and numbing for a budget. When risk becomes granular, fairness often feels less personal. They thought about moving. Friends sent listings in lower-risk counties. Then came the fine print. Those markets had seen an influx too, prices up, services strained, insurers wary of new concentration. The risk map follows the economy. People chase affordability. Insurers chase diversification. Reinsurers chase returns. The family kept chasing a stable promise that kept stepping back. In the end, the map did what maps do. It described terrain, not choices. The choices were the family's to make with fewer safe paths. Climate and crime weren't headline villains. They were inputs in an engine that priced protection exactly as the world revealed itself, month after month, invoice after invoice. PE's playbook inside health and auto. From their perspective, the pain didn't start with a denial, it started with a deal. After a quiet acquisition, the language around their health plan shifted. Care management became utilization optimization. Member experience turned into engagement. None of those words said deny. They didn't need to. The playbook lives in the plumbing. Here's the structure. Private equity buys a health plan, a benefits administrator, or a third-party claims platform. Sometimes it's adjacent, pharmacy benefit managers, prior authorization vendors, specialty networks. The thesis is consistent: consolidate fragmented services, centralize decisions, and scale through software. The revenue model often charges per member, per month, with bonus pools tied to medical loss ratios and savings. When savings are defined as less paid out, the direction of travel is set. What nobody outside the room hears are the targets. Not deny more care, but reduce average paid per episode by 2%, increase step therapy adherence, raise generic fill rates. Those get translated into build tickets for the claims engine. Clinical criteria plug into decision trees. If X, then request documentation. If Y, then step therapy first. If Z, route to nurse review with a 72-hour clock. None of it looks malicious. All of it adds friction at scale. Meanwhile, the auto side mirrors the move. A PE-backed carrier buys a telematics startup, a photo estimation vendor, and a network of direct repair shops. The pitch is speed. Approve simple claims faster, steer volume to preferred shops for better rates, and use AI to detect inflationary supplements. The first estimates trend low. Shops push back. The system budgets for a certain percentage to accept. The first offer. Savings accrue on acceptance, not on fairness. Regulators approve because cycle times drop. Back in their week, the family felt it as a series of helpful nudges. The health app suggested a lower-cost imaging center 30 miles away. The pharmacy plan flagged a prior auth for the brand inhaler and suggested a formulary alternative. The auto insurers app asked them to upload photos after a parking lot scrape. An offer arrived before dinner. It was fast. It was also $400 short of the body shop's estimate. Here's where the playbook compounds: carve-outs and vendor stacks. A health plan might outsource prior authorization to a PE-owned firm, pharmacy management to another, and complex care to a third. Each layer earns fees on throughput and savings. The plan's medical loss ratio improves. Providers see more portals, more logins, more criteria. Patients see more "we're working on it" messages. On paper, accountability exists. In practice, responsibility is diffused. The auto claim followed the same logic. Their insurer had a preferred network with guaranteed workmanship and negotiated labor rates. The shop outside the network could do the work sooner, but the insurer capped line items based on standard hours and parts prices from a database. The manager said, "We can fight it, but it'll take weeks." The family took the check. The carrier's dashboard recorded a win: cycle time down, severity contained. Meanwhile, something else was happening behind the curtain: data flywheels. Every denial reason, every appeal outcome, every supplement approved or rejected feeds the next model iteration. The health plan learns which providers appeal and which don't. The auto carrier learns which shops push hardest and which zip codes accept first offers. The models don't punish, they allocate attention. Tighten here, loosen there, maximize savings, without crossing complaint thresholds that trigger audits. There was one problem: savings targets can clash with outcomes. In health, delayed approvals sometimes mean canceled procedures, emergency room visits, or higher downstream costs. In auto, underpaying early can lead to more supplements, rental car days, and unhappy customers. The playbook adjusts by setting red lines. No denial for codes A, B, C. Auto-approved bundles under $X. Escalate doctor disputes after 2 touches. It's risk management by Triov, not by trust. The family's doctor learned the rulebook and played it. He submitted notes using the plan's preferred phrases, referenced criteria, and requested peer-to-peer calls early. Approvals came faster. The lesson was cynical and true. Speak the machine's language or wait. Their auto shop learned, too. It documented with photos, cited OEM repair procedures, and queued supplements in batches. Checks got bigger. Time got longer. On quarterly calls, the PE owners praised operational excellence. They highlighted margin expansion from expense discipline and technology leverage. They mentioned enhanced consumer choice through tiered networks and transparency tools in apps. They didn't mention the family's 2 nights on hold or the weeks waiting for an inhaler exception. They didn't need to. The metrics told a clean story. Regulators noticed the rough edges. Some states proposed timelines for prior auth and disclosures for auto estimates that rely on AI. Firms complied, posting timelines and adding human review available buttons. The experience improved at the margins. The incentives didn't move. As long as profits flowed from fewer dollars out the door, the smartest engineers would keep finding steps between injury and payment, between prescription and pickup. Here's the quiet reveal. PE didn't invent these tactics. It synchronized them. By owning the nodes, carriers, TPAs, PBMs, vendor platforms, it aligned the gears. Each gear turns a little faster. The machine runs smoothly. On the other side of the glass, a family arranges their life around a cadence they didn't set. The playbook isn't a secret. It's a system that treats protection as a product line with targets to hit and quarters to close. The exit, how they cash out. From their perspective, the pressure felt endless. From the owner's perspective, it had a timer. Private equity doesn't hold forever. It builds, optimizes, and leaves. The question isn't if, it's how. There are 3 main doors: sell to another sponsor, sell to a strategic buyer, or list it. The most common is the first 2. A sponsor builds a platform, brokerages rolled up, TPAs centralized, tech stacked, and then flips it to a bigger fund that can take it the next mile. Each flip resets debt, resets value creation plans, and extends the system's life. The second door is a strategic. A national carrier or brokerage buys the platform for scale and distribution that can smooth costs further and keep the rate discipline that made the platform valuable in the first place. The IPO is rare in this cycle, but when capital markets thaw, it reappears as the cleanest scoreboard: growth, margins, and narrative crystallized into a ticker. Here's where it gets concrete. A mid-market platform buys 30 regional agencies over 3 years at lower multiples than it paid for the first. The math is accretive from day one. EBITDA grows from synergies, shared back office, unified placement, renegotiated commissions. Debt service is covered by rising premiums and expense cuts. When rates across the market jump 8 to 10% and reinsurance rationalizes, the story looks better. Strong top line, disciplined underwriting, enhanced unit economics. A larger buyer pays 17x because the hard market makes earnings look durable. The sponsor books the gain. The new owner inherits the playbook and the pressure to keep the numbers where the multiple assumed they'd be. Meanwhile, a second track runs through the insurer's balance sheet. When an asset manager owns or controls an insurer, the float becomes permanent capital. Management fees accrue on the assets under management, not just underwriting profit. The exit can be twofold: sell the operating platform for a multiple and keep managing the assets for a fee. Even if the operating company changes hands, the investment advisory contract can persist. That's the quiet victory. The fee stream outlives the deal. Another route is the carve-out. A sponsor separates the high-margin services, claims administration, prior authorization tech, network management, into a distinct entity. The insurer or TPA becomes a captive client. The services company sells to a different sponsor at a SaaS-like multiple because revenue looks contracted. The remaining insurer keeps paying for the tools that once lived in-house. Costs migrate from internal expense to external fee. Margins look tidy. Consumers don't see the carve-out. They feel the persistence of the workflow. There's also the offshore loop. By reinsuring blocks to a Bermuda affiliate, The company frees up capital, boosts return on equity, and shows a leaner profile to buyers. On exit, the buyer acquires an insurer with less required capital per dollar of premium and a proven structure to invest in higher-yield assets. The seller may retain an interest in the reinsurance vehicle, keeping economics after the sale. Again, the exit isn't just a price, it's a path to keep earning. What nobody at the kitchen table hears is the exit committee's checklist. Retention of key producers? Locked. Long-term distribution agreements? Signed. Reinsurance treaties renewed at tighter terms? Completed. Denial rates stable within tolerance and complaints contained? Yes. Regulatory inquiries answered? Filed. Each box isn't about people. It's about risk to the multiple. On closing day, the press release reads like every press release. We're excited to partner for the next phase of growth. The CEO thanks employees. The buyer praises culture. The sponsor nods to innovation. No one mentions the family's new escrow payment or the neighbor's force-placed policy. They don't have to. Those cash flows are the reason the EBITDA looks sturdy. After the flip, targets reset. The new owner wants growth organically and through add-ons and expects continued pricing adequacy. If the market softens, the pressure shifts to more add-ons and deeper expense cuts. If it hardens, price holds and margins expand. Either way, the cadence continues. Quarterly reviews of severity, cycle time, utilization, and actuarial soundness. Appeals remain low relative to denials. Reinsurance ROEs justify discipline. State pools swell quietly. The machine moves. There's one more exit that rarely gets named: the consumers. People leave the system by degree. They raise deductibles until coverage is theoretical. They skip dental. They drop comprehensive on an old car. They roll the dice on health until a crisis lands them in a deductible cliff. It isn't an official decision. It's attrition. From an investor's perspective, churn is a metric with a tolerance band. From a family's perspective, it's the last move they never wanted to make. In the end, cashing out isn't a twist. It's the design. Build scale, align incentives to protect capital, convert friction into savings, and sell the story that those savings are efficiency, not extraction. The exit's clear. The funds distribute. The cycle looks complete, until the next letter lands in a mailbox that paid for the runway out. Public backstops, private gains. By the time their escrow stabilized, they'd learned a new acronym: FAIR. The state's insurer of last resort had become their backup plan, one they hoped to avoid. Unknown to them, across their state, enrollment in the FAIR plan had climbed as private carriers trimmed exposure. Premiums were higher, coverage tighter, and assessments loomed in the fine print. If a big catastrophe hit, all policyholders in the state could be billed to fill the hole. Public backstop, private retreat. Here's how the bridge gets built. When private markets won't write policies at a price people can pay, states step in to prevent a coverage collapse. Fair plans and beach or wind pools collect premiums by reinsurance and hope loss years stay manageable. When they don't, deficits get funded by assessments on the broader market, sometimes spread across all insurers, sometimes recovered from policyholders over time. It's a safety valve that keeps mortgages legal and neighborhoods insurable. It's also a quiet transfer, risk socialized, premiums still individualized. Meanwhile, something else was happening upstream. Reinsurers, flush with capital and discipline, sold protection to those same public pools at prices that reflected the hottest risk. Coupons on catastrophe bonds rose. Dedicated capital touted double-digit ROEs. Private balance sheets got paid first. Public pools paid the freight because they had to. The choice wasn't between expensive and cheap. It was between expensive and no coverage. The family's broker explained the trade. The FAIR plan would cover fire, but not necessarily theft, water backup, or liability at limits they were used to. Add-ons existed, but the total would still land above their surplus line's premium, and next year's renewal could shift again. They stayed put. Their neighbor didn't have a choice. She enrolled in the state plan and braced for an assessment clause she didn't fully understand. "If a big one hits, we all chip in," the agent said. She nodded. The mortgage servicer just wanted proof. On the health side, public backstops were different names: Medicaid expansion, ACA marketplaces, and state high-risk pools where they still exist. As employer plans narrowed networks and denials rose, more people slid toward public coverage, by eligibility or by necessity. Taxpayers funded the floor. Private payers skimmed the healthier, higher-margin segments and negotiated rebates and discounts in a maze nobody outside could audit easily. The family paid taxes into the pool and premiums into the plan. Both dollars kept the lights on. There was a second layer: disaster aid. When fires or storms overwhelmed neighborhoods, federal dollars arrived through FEMA grants and SBA loans. Insurance deductibles that had ballooned into five-figure hurdles got bridged by public money. Slow, partial, means tested. The reinsurers quarterly looked steady. The carriers' combined ratio stayed respectable. The gap between what policies covered and what people needed got filled by checks with government letterhead. In the municipal budget, the shift showed up as line items: wildfire mitigation grants, hardening programs for public buildings, flood control investments after, once in a century, became twice this decade. Cities issued bonds to raise levees and expand culverts, while insurers revised maps and charged more anyway. The public paid to lower hazard. The private markets priced the residual risk at levels that preserved returns. The family paid twice, once on tax day, once at renewal. Unknown to them, across the Capitol, lawmakers debated a reinsurance backstop for the state plan. Public dollars to buy wholesale protection so fair rates wouldn't spike further. Industry groups supported the idea. Stability helps everyone. Consumer advocates asked why taxpayers should subsidize and exit the private market had chosen. The answer, stripped of ceremony, was simple: because the alternative was uninsured mortgages, broken housing chains, and defaults. The public didn't like the bill. It paid it anyway. Here's the quiet symmetry. Private equity's insurance thesis depends on predictable cash flows and disciplined risk selection. Public backstops exist to absorb the volatility those disciplines push away. When catastrophe seasons stay active and crime and convective storms nibble at margins, the distance between stabilized returns and stabilized lives is bridged by assessments, subsidies, and emergency appropriations. The family's premiums by protection, their taxes by availability. Health care traced the same arc. As denial rates rose and appeals remained rare, hospitals leaned on disproportionate share payments and state supplements to keep afloat. Rural facilities depended on public funding to offset uncompensated care. Meanwhile, plans improved MLRs and vendors booked savings fees. Patients navigated charity care policies and GoFundMe pages. The public paid for access that the private market controlled at the gate. The family didn't begrudge safety nets. They'd needed one twice, once after a job loss, once after a storm. What grated was the sense that the nets were increasingly there to catch what profitable models dropped by design. Their state funded the plan that would write the policy that kept their mortgage compliant. Their federal taxes supported the relief that would patch what exclusions left out. The architecture worked. The incentives were lopsided. In boardrooms, investors praised resilience. In hearings, officials praised stability. At the kitchen table, the word that mattered was affordability. Public backstops kept the floor from collapsing. Private gains kept ceilings intact. The load in between got heavier every month for the people holding up the house. The housing flashpoint. The first for sale sign on their block looked like normal turnover. The second came with a rumor. The sellers couldn't get affordable insurance. The third made it plain. Showings were quiet. Buyers asked the same question first, not last. Can I insure this house at a price that keeps the mortgage payment steady? The agent didn't have an easy answer. The spreadsheet did. Here's the fuse. In a market with thin inventory, prices held up even as rates rose. But insurance wasn't a rounding error anymore. It was a second-rate hike. A $3,000 premium becoming $7,500 changed debt-to-income ratios. Lenders re-underwrote mid-escrow. Some deals fell apart over a quote. Others limped to closing with force-placed contingencies and side agreements that everyone hoped would unwind at renewal. Underwriting didn't fail. It stalled. Meanwhile, something else was happening in builder offices. Permits slowed in high-risk zones. Projects penciled only if insurers would pre-commit capacity or if homes included expensive hardening by default. Developers asked carriers for site-by-site indications months before breaking ground. Carriers hedged, pointing to reinsurance panels and models that might shift by delivery. If the product you sell depends on another product's availability, your business plan becomes a weather report. In open houses, buyers scanned kitchen islands and then asked about wildfire scores, flood maps, and theft claims in the area. The listing packet included mitigation upgrades like they were countertops, Class A roof, ember-resistant vents, cleared defensible space, monitored security. The premium quote sat alongside the mortgage estimate. For some, the combined number killed the tour. For others, it forced a trade, by smaller, by farther, by later. The family watched a neighbor accept an offer 10% under last spring's comps. The buyer demanded a credit to cover a year of surplus lines premiums plus a reserve for the percentage deductible. The seller took it. He'd already lost 2 buyers to insurance surprises. The appraiser noted market conditions. None of the comps captured the letters that had arrived since. Unknown to them, across town, the city's housing task force fielded calls from agents about a silent freeze. Not a crash, no panic listings, no foreclosure wave, just a stickiness that jammed chains. Seniors who would have downsized stayed put because the new condo's HOA master policy was unstable and the special assessment for insurance made dues jump. Young families who would have stretched for a bigger place ran the numbers and saw the escrow line eat childcare. Investors backed off short-term rentals as property policies excluded secondary homes or priced them like luxury goods. Affordability wasn't just rates and prices, it was the cost to keep a roof insured. On the rental side, multifamily owners renewed property layers with stricter terms and higher deductibles. Some shifted losses into operating budgets. Those budgets rolled into rent. Tenants felt an increase they couldn't trace back to an attachment point discussion in January. When a hailstorm hit, repairs took longer, deductibles emptied reserves, and amenities closed pending insurance approval. It read like maintenance. It was capital structure. Mortgage brokers started asking a new question up front. Have you gotten an insurance pre-quote? In certain zips, they wouldn't lock a rate without it. The lender overlays, extra conditions on top of agency rules, expanded quietly. If the only carriers writing were surplus lines with cancellation clauses and no guaranteed renewal, the file went to manual review. Manual review meant time. Time killed more deals than price. There was one more pressure point: condos. Associations saw master policies spike or carriers exit midterm. Boards raised dues or levied assessments. Lenders flagged buildings on unavailable/declined lists. Buyers needed higher down payments or walked. Sellers watched values flatten not because the units were worse, but because the insurance wrapper around them had thinned. The building was sound. The market around it wasn't. Meanwhile, public backstops tried to keep transactions legal. Fair plan confirmations became attachments to purchase contracts. Some sellers offered to prepay a year of state plan premiums as a concession. Others agreed to close with an insurance contingency that let buyers cancel if quotes blew out. Escrow officers learned new scripts. Title companies added riders. Complexity grew like ivy. The family drove past a new development with banners that said "Hardened Homes, Insured Community." The sales rep pitched a carrier partnership that pre-vetted the tract and guaranteed initial coverage if buyers completed required upgrades. It sounded like a solution and a warning. Housing, once a product with predictable carrying costs, now required insurance choreography baked into the design. Then came the news story that made the group chat buzz. A small town's council paused new building permits after insurers pulled back from the area. No ban on paper, just a temporary moratorium to reassess fire response times and mitigation standards. Builders protested. Residents shrugged. The market had already paused itself. Here's the flashpoint. Housing doesn't need a headline crash to break. It can seize quietly when a basic input, insurability, turns uncertain. Prices don't have to fall fast. They can flatten while costs climb, extracting the cushion that kept owners secure. The next shock doesn't have to be a foreclosure wave. It can be a slow migration of families leaving high-risk, high-premium zip codes for places where the escrow line is smaller and the map is friendlier. The sign on the lawn doesn't say, "Insurance Crisis." It says "Price Reduced." The reason sits in a file folder labeled "Renewal." Pressure valves and workarounds. The week after the third price-reduced sign, their group chat turned into a toolkit. Not solutions, pressure valves. Ways to make the month work without fixing the system. First came bundling. The broker priced home, auto, and an umbrella with one carrier. The discount looked decent. The catch sat in the fine print. If the home got non-renewed again, the auto discount vanished. One bundle, one hinge, one more thing to watch. Then came higher deductibles. Move wind and hail to 5% to keep premium under a breaking point. The number on paper dropped. The math under stress jumped. A roof claim would now require $30,000 before coverage. They labeled a savings account deductible, which felt like saving for a disaster they were paying to insure. A neighbor tried parametric add-ons. A private flood policy that pays if rain hits a set threshold. A wildfire policy that triggers on perimeter breach, not adjuster estimates. Payouts were fast, amounts small, premiums not trivial. It worked like aspirin. It didn't cure the disease. Mitigation credits showed up as a checklist. Class A roof, ember-resistant vents, cleared defensible space, mesh on attic openings, gravel strip against the fence. Each item shaved dollars. None reversed the base risk score. Credits softened increases. They didn't flip red to green. Still, the receipts mattered. One carrier offered a conditional renewal if all items were completed in 60 days. They hustled, borrowed a truck, filled green bins, and learned the names of 3 roof tile suppliers. On health, the workaround was language. Their doctor wrote notes in the plan's dialect. Trial and failure for the old inhaler. Risk of decompensation for the imaging request. Approvals came faster. It felt like gaming. It was compliance. The office hired a prior auth coordinator whose job was to feed the machine the right words in the right order. When the auto renewal jumped again, the agent pitched telematics. You drive carefully, you'll save. They tried it. The app flagged hard braking on potholes and late-night driving after a hospital visit. The discount was modest. The sense of surveillance was not. They opted out at renewal and paid the middle tier. A friend leaned in and hacked the system. Mount the phone in a stable holder, avoid music apps that confuse motion sensors, plan routes to avoid known rough streets. Workarounds piled on a product that once just existed. Meanwhile, the independent broker expanded her playbook. She shopped surplus lines more aggressively, phoned underwriters instead of relying on portals, and built a mitigation photo library for each client. She tracked reinsurance panel chatter to anticipate carriers that might pull back at mid-year. She wasn't a salesperson anymore. She was a navigator through a moving map. Her commission statements showed smaller base rates, more fees, and more hours per file. She stayed because her clients did. Across town, the HOA brought in a consultant to keep their condo master policy insurable. Sprinkler upgrades, firewall verifications, electrical panel replacements, capital projects turned into underwriting credentials. Dues went up. Sales stabilized. The board president absorbed the complaints and the gratitude in the same meeting. A friend discovered a state mitigation grant that covered half the cost of hardening. The wait list was long. Persistence helped. They got funded in round 2. The crew installed ember-resistant vents and metal gutter guards. The carrier still moved the wildfire score, but the renewal letter came with less sting. Not fixed. Not nothing. Some households self-insured slivers. They dropped comprehensive on cars over a certain age, raised medical deductibles to fund HSAs, and bought smaller personal articles policies just for items that would hurt to replace. They joined autobody cash networks that negotiated rates in exchange for skipping insurer fights. They asked doctors for cash prices when prior auths threatened to delay time-sensitive tests. They learned to say, "What's the code? What's the cash?" Others went upstream to employers. HR teams, facing their own premium spikes, added advocacy vendors. Nurses who would work denials, pharmacists who would appeal step therapy. It wasn't altruism. Lower friction meant fewer angry emails and less deferred care. The service helped. The denials didn't vanish. They rerouted through professionals who knew how to knock. Mortgage workarounds looked like calendar games. Escrow analyses happen annually. Timing matters. They prepaid a cushion before the calculation to blunt the jump. They scheduled policy bind dates to avoid gaps and lender force-place scripts. They kept digital copies of declarations and mortgagee clauses ready for upload to whatever new servicer portal arrived with the next transfer letter. It felt like tax season every season. Communities built their own safety nets. A neighborhood chat started a claims co-op, a Slack channel where people shared denial letters, sample appeal language, and contractor recommendations that actually got supplements approved. Someone uploaded a template for wildfire non-renewal appeals. Someone else posted a spreadsheet of carriers still writing within a 20-mile radius. Crowdsourced survival replaced assumed protection. There was a darker workaround, moving. Friends left for counties with calmer maps. Grandparents took in families between renewals. Remote workers traded fire risk for flood risk because premiums penciled. The exit wasn't dramatic, it was steady. School rosters shifted. Little league teams merged. The insurance line moved people without ever appearing in a headline. One night, they tried something simple. They called the commissioner's consumer line again and asked for a list of carriers still writing in their zip. The staffer emailed a PDF and a note. This changes monthly. It wasn't much. It was honest. They sent it to the chat. None of these valves solved the pressure. They released enough to get through quarters and renewals. The family learned to live with a constant hum in the background. The knowledge that a model update, a treaty renewal, or a vendor contract could tilt their month again. Workarounds kept them standing. They wanted a system that didn't require them. Realigning incentives. The week the group chat turned into a toolkit, someone asked the question beneath all the workarounds. What would it take to make the system reward protection again, not extraction? The answers weren't slogans. They were levers. Start with the map that moved under their feet. If carriers price neighborhoods monthly, then mitigation has to move on the same clock. Not a brochure credit, a binding rule. Verifiable hardening, Class A roofs, ember vents, defensible space, must reduce scores by set amounts, reviewed annually, published publicly. Make models compete on how fairly they recognize risk reductions. Tie regulatory approvals to transparent mitigation factors, not just loss curves. When homeowners can see what shrinks their premium, they'll do it. When carriers must show their work, the discounts stick. Next, align reinsurance with community resilience. Right now, the best returns reward selective exposure. Add a lane that rewards protected exposure. Offer capital relief or tax credits when reinsurers support carriers writing in verified hardened corridors. Blocks or tracks that meet measurable standards. States already subsidize mitigation. Let them co-buy reinsurance for those corridors, conditioned on carriers offering guaranteed renewals and capped catastrophe deductibles for households that maintain upgrades. The reinsurer still prices risk. The public share lowers volatility where people already invested in safety. Then fix the floor under deductibles. Percentage deductibles turn homeowners into the first layer of reinsurance. Cap catastrophe deductibles as a share of income, not just dwelling value, for primary residences. If that sounds messy, look at how utilities handle low-income protections. Build an income-verified tier that limits out-of-pocket on essential perils, funded by a small statewide surcharge and reinsurer co-participation. The moral hazard fear assumes people invite fire. The data says they don't. A floor keeps families from insolvency after doing everything right. On the mortgage side, slow the trapdoor. Require a 60-day cure period before force-placed coverage can bill beyond the exact lapse days, and cap force-placed rates to a benchmark tied to average admitted carrier quotes in that county. Ban fees layered on top. Mandate real-time data pipes so brokers can push bind confirmations directly into servicer systems. If the collateral must be protected, build a lane that protects the borrower from software clocks and vendor penalties. Health has its own levers. Prior authorization should be a clinical tool, not a revenue model. Set a federal standard. Automatic approval for services with denial overturn rates above a threshold. Time limits that trigger default approvals, and transparent criteria with patient-facing explanations. Tie plan accreditation to appeal access and staffing ratios for utilization review. Ban per denial or savings share compensation for third-party vendors. If a plan wants to outsource, it pays a flat PMPM, not a bounty on friction. Pharmacy benefit managers need sunlight and alignment. Force pass-through of negotiated rebates at the point of sale for essential medications like inhalers and insulin. Disclose spread pricing and prohibit it in public programs. Then let states copy the rule for fully insured commercial markets. When patients see the real price, adherence improves, and the savings metric stops punishing people who need the brand that actually works. In auto, pair telematics with rights. If carriers rate on driving data, then policyholders must own and port that data. A clean record with one app should lower prices. Across carriers, not lock a household into a single platform. Require a human rear review when AI photo estimates are disputed and an OEM procedure is cited. Publish insurer-level gaps between first offers and final payments. When the delta is visible, the incentive to lowball quietly fades. Realigning incentives also means restoring competition where consolidation dulled it. In distribution, set conflict of interest rules for broker compensation that prioritize client outcomes over contingent commissions. Make market access data transparent. Which carriers declined and why. Fund community-based mutuals and co-ops with startup reinsurance support so neighborhoods can pool risk where commercial appetite thinned. Mutuals aren't magic, but they answer to policyholders, not exit committees. On ownership, draw clearer lines between asset management and underwriting. When an asset manager controls an insurer, require independent investment committees with public reporting on private asset concentrations, affiliates, and offshore reinsurance links. Capital efficiency shouldn't be a maze. If a Bermuda affiliate frees reserves, disclose the economics and who earns fees after the deal. Sunlight won't stop every aggressive structure. It will price it. Regulators need sharper tools and a different mandate. Give insurance departments an affordability test alongside solvency, the way utility commissions weigh rate requests against household impact. Create fast-track approvals for filings that lower premiums via proven mitigation, and reject those that raise rates while cutting coverage without transparent justification. Fund consumer offices to audit denial engines and catastrophe models with independent experts under strict confidentiality. Then publish lay summaries. Complexity is a moat only if no one's paid to cross it. Public backstops can demand more in exchange for stability. If fair plans and state pools by reinsurance, negotiate community benefits. Guaranteed minimum offerings in designated corridors, standardized renewal protections, and joint investments in local mitigation. If taxpayers are the ultimate shock absorber, require the private market to share the work of lowering the shocks. Finally, center the kitchen table in the metrics. Tie executive bonuses at Insurers, TPAs, and PBMs partly to net promoter scores from claimants and to time-to-resolution benchmarks, audited externally. If you can engineer savings, you can engineer satisfaction. Make both matter. None of this is a slogan. It's plumbing. Levers that nudge capital toward protection instead of just prudence, that pay families for the work they do to lower risk, and that keep the promise of insurance recognizable to the people who fund it every month. The families return, payoff, and stakes. Spring came back the way it always does. Light through the blinds, pollen on the hood, a stack of envelopes on the table. The renewal letter was on top. They didn't open it right away. They made coffee first. They sat together. Then they slid a finger under the flap and read. The number wasn't good. It wasn't catastrophic either. Up 8%. The wildfire deductible held at 5%. The mitigation credits showed as line items: ember vents, roof class, defensible space. The surplus lines carrier offered a conditional guarantee. Keep the upgrades current, no claims above a threshold, and they'd review for renewal without a lapse. It wasn't a promise. It was a path. They built their month around that path. The escrow projection still had a wobble. The servicer's new analysis spread the shortage over 12 months. Groceries stayed lean. Vacations stayed theoretical. They kept the second car because selling it would save insurance but add complexity to work and school. Trade-offs settled into habit. Then life tested the plan the way life does. A windstorm ripped a section of ridge cap. The roofer's bid landed below the deductible by a mile. They paid cash and told the kids it was homework for the house. A pharmacy glitch put the inhaler back behind a prior auth after a formulary update. The doctor sent the right phrases. Approvals arrived a day late, and they borrowed puffs from a neighbor. The auto app nudged them to rejoin telematics. They passed. There were small wins. The state mitigation grant hit their account months after the work was done, a quiet backfill that made the credit card stop glaring. The broker found a modest umbrella policy that didn't hinge on the home carrier. The HOA fixed a drainage issue that had flooded a corner lot last year. On the neighborhood forum, the theft thread slowed a little after a rash of arrests and more porch lights. They also watched people leave. The neighbor with the force-placed policy sold to a couple from the valley who arrived with a quotes folder and a willingness to live with a high deductible. Another family moved inland to a town with lower scores and commuted back twice a week. The block lost a dog, gained a trampoline, and learned a new set of names at Halloween. Stability felt like a rotating cast trying to play the same scene. On a quiet Saturday, they opened a spreadsheet they hadn't touched since the panic month. They listed every lever they'd pulled: mitigation receipts, appeal letters, escrow timing, broker notes, vendor portals, grant IDs. It read like a survival guide. It also read like a job. They looked at each other and asked the question they'd been avoiding. Is this still home if home is a negotiation with maps and models every quarter? They didn't decide that day. They planted tomatoes. They scheduled the chimney sweep. They sent a thank you to the broker with a photo of the new vents. They called their parents and said they were okay. It was true, in the way that being okay means you're carrying weight you didn't use to carry and haven't dropped it yet. Meanwhile, upstream, nothing paused. Reinsurers prepared mid-year renewals. The state floated a bill to expand the Fair Plan's reinsurance backstop. The health plan tweaked criteria codes. The servicer sold another block of loans. The machine turned. The family did too inside it. Here's the payoff and the stakes. They kept the roof insured. They kept the house theirs. But the price of that success was time, attention, and cash redirected from the life they imagined to the risk they could measure. The stakes aren't theoretical. They're months added to a mortgage, hours spent on hold, miles driven to a cheaper scan, dollars held back from a future to meet a model's present. They won for now. The question is whether winning should have to look like this. What they carried is what millions are carrying. Risk shifted upstream into models and downstream into wallets until protection feels like a part-time job. If this keeps compounding, the middle of the map empties out. If you want the rest of this story, the levers that actually move premiums and the neighborhoods rewriting the rules, watch the next episode. Subscribe, share this with someone juggling a renewal letter, and tell me in the comments which lever you'd pull first.